This is going to be our first lecture on stock valuation. In this section, we're going to cover some concepts right up until the idea of calculating the stock price as a series of future expected cash flows where you're given a series of dividends. So after this video, you will watch the first example from the Excel videos. That's going to show you the calculation that we end here with. Okay, so here you see this picture is a stock certificate. It actually has 10 written on there. So this is for 10 shares of Baltimore and Ohio Railway Company. So what does it mean if you were to purchase this stock certificate? Well, it would mean that you are a partial owner. You own 10 shares of the Baltimore and Ohio Railway Company. Well, what does it mean to be a stock owner? That means that by owning, that means that you have some sort of control. Well, what is that control? What is the point of owning a stock? What control do I get? Your control really is about the ability to elect the board of directors. The board of directors are important because they select the management and they ensure that the managers are working to maximize shareholder wealth, which is you because you are a shareholder. So what does it mean to maximize shareholder wealth? How do you maximize shareholder wealth? Well, that wealth can come in the form of a return. So what is the return? It can be broken down into two components, a dividend yield and a capital gains yield. So this is the realized rate of return that you would earn on a stock. The second part of it, the capital gains yield here, is just a percentage change in price. So any other kind of percentage change that you would do, end minus beginning divided by beginning. Remember, P0 is always our stock price today. So the capital gains yield is the second part of this equation, just a percentage change in price. So if the managers are working to maximize shareholder wealth, then you would expect the stock price to go up, and that would be positive capital gains or capital appreciation. You could also have a capital loss if P1 was less than P0. The other part is the dividend yield. So what is a dividend? A dividend is something that a company pays out to its shareholders, kind of sharing the wealth, saying, all right, here's the amount of money that we earned, here's your portion of it. And we'll talk a lot in these presentations about how the companies make the decision about what proportion of their earnings to pay out in the form of dividends. But for right now, just know that a dividend is paid to the shareholders. And that's one of the ways that they get their return. So the dividend yield is the dividend divided by the price. So the dividend yield plus the capital gains yield together determine the overall expected rate of return that a shareholder receives on their stock. All right, so what about companies that don't pay dividends? Well, then their entire portion is going to be just coming from expected capital appreciation. What determines a stock's price? Well, a stock's price is determined by investor expectation. So it's supply and demand. There's only so many shares out there, right? The company can decide to issue additional shares, but if they do that, then there would be increased supply, that would be downward pressure on the price. But assuming that a company does not go ahead and issue any additional stocks, what determines its stock price? Well, that's going to be investor demand. Okay. So the more people want to buy the stock, the higher the stock price is. All right, makes sense? Well, what makes people want to buy a stock? Do you want to buy a stock if you think the stock price is going to go down? Probably not. So you'll see increased demand when you think a stock price is going to go up. Well, why would an investor think a stock price is going to go up? It must mean that you think the company is doing well, right? So one of the things that we'll talk about is how we forecast the company's growth based on their cash flows. And then our logic for estimating a stock price is going to be following time value of money logic. We're going to call it discounted cash flow based methodology. So we're going to forecast their expected future cash flows based on their growth. And then we're going to say, all right, well then let's discount all those cash flows back to what they're worth to me today. And the sum of those is going to be my stock price. All right, well, If you are if you are owner of a share of stock, then that means you are receiving dividends. You're not getting all of the cash flows from the entire company. All you are receiving are the individual dividend payments. So if we assume that, and we assume you can correctly forecast cash flow growth, that therefore you can correctly forecast dividends, then you can ultimately value the stock as the present value of all future expected dividend payments. Now, there's a lot of assumes and if you cans in that sentence. So obviously, this is an economic model, and all economic models are based on gross simplifications of reality. But that's the logic under which we're going to be working. So let's show how that works. The value of the stock today is the present value of all future expected dividends generated by that stock. And at this point, I'm going to say really future expected cash flows. Why? Because D stands for dividend, P stands for price, K stands for cost. So KE is cost of equity or required rate of return on equity. This could be determined by CAPM or your risk-based required rate of return like we just talked about in Chapter 8. All right, so, and generally, more risky stocks have higher required rates of return. All right, so then why is there a P on here if I said the stock price is the present value of all future expected dividends? Well, the logic here is that while it may be reasonable for us to forecast future dividends for 1, 2, 3 years out when we know what the company is doing, as we get farther and farther out, our forecasts are going to be much more guesswork, right? So at some point, we just cut it off and say, all right, well, here's what I think my best guess of what the stock price is going to be at that point based on what I think is going to be happening in the future. So we're just going to cut it off there. And then the stock price is determined as the sum of the present value of that future cash flow stream. So let me show you an example of this. Current forecasts are for XYZ company to pay $3, $3.24, and $3.50 over the next 3 years, respectively. So their dividend in 1 year is going to be $3. The following year, their dividend in year 2 will be $3.24, and then their dividend in year 3 will be $3.50. We also anticipate selling the stock in 3 years' time for roughly $95. What is the price of the stock given a 12% required rate of return? All right, so how are we going to do this? We have expected future cash flows of $3 in year 1, $3.24 in year 2, $3.50 plus roughly $94.50 in year 3. We're going to discount all of those back to their value in year 0 at 12%. And this is showing it algebraically as 3 separate present value calculations. Note that the final dividend of $3.50 and the $94.48 are both received in year 3. That's why they're lumped together. Calculate the present values of all of them, add them up, you get $75. So go ahead and check out the first Excel example video, and I will show you how to do this question in Excel.